Michael Burry expects U.S. stocks to fall further, and many investors to incur heavy losses. The Big Short, a comedy-drama from Paramount Pictures that year, demonstrated how Burry had gained millions by correctly predicting and capitalizing on the subprime mortgage crisis that had afflicted the United States from 2007 to 2010. Few people listened to Burry in 2005 when he bet against the housing market, but now they're more likely to pay attention, since he has a lot to say about how the market will develop over the coming years. In this video, we will look into Michael Burry's 2022 stock market crash prediction. If so, how can you safeguard your possessions? Here's Michael Burry's warning for 2022. Earlier this year, in February, Michael Burry tweeted that there would be substantial inflation as a result of the Federal Reserve's historic stimulus spending. He used the hashtag doomed to repeat and criticized the U.S. government and the Federal Reserve for their trillion-dollar stimulus program. And he was the dissenter at this time. All appear to be well at the moment. Although the Fed was producing money, inflation remained low. The most recent data available at the time indicated an annual inflation rate of just 1.7%, which was below the Fed's target. He was simply early, in typical flaming fashion. 12 months later, we're already seeing an inflation rate of 8%, which is so high that practically anything on YouTube can become a broken clock in 1 to 2 years. Naturally, Burry tweeted a month ago in response to Elon Musk's post in which he referred to Burry as a broken clock. But what's really intriguing is that Michael Burry hasn't simply been doing victory laps over the previous few weeks. Instead, he has been extensively tweeting about the reasons he thinks this economic crisis and ensuing market decline are just getting started. To begin to comprehend Michael Burry's thoughts, I do want to at least go over his entire reasoning. He does believe that the worst is yet to come. Thus, that is the main message. So much so that he believes the S&P 500 might drop another 50% from where it currently stands. Burry tweeted on May 3rd about paradigm shifts and speculative peaks, saying that the S&P 500 had bottomed out at a value of 1866, which was 13% below the low of 2000, 17% below the low of the LTCM crisis in 1998, 10% below the low of the 1970s, and 15% below the COVID low. The S&P 500 had bottomed out 17% below the low of 2000, and 97% below the low of 1908. The bottom of a current market crash, however, is typically lower than the one that came before it, by about 10 to 15%. Adding that 15% below the S&P 500 low from 2020 brings us down to 1862 points, according to the trend we've seen over the past 25 years. That's absurd, since it implies that Michael Burry expects a peak-to-trough decline of 61.4%, which would return us to the historically usual shoulder of about 16. In essence, Michael Burry predicts that the stock market will decline by a further plus 50% from where it is now. Given that the market has recently had a 6.5% bounce, this daring prognosis has once again drawn criticism. However, as we have seen over the course of just the last few days, short-term bounces do not necessarily indicate that things are in the clear. Michael Burry also made a comment regarding this conceivable scenario. He recently tweeted, quote, that 12 out of the top 20 NASDAQ one-day rallies occurred during the 78% decline from the peak of the 2000s. 9 of the top 20 S&P 500 one-day rallies occurred during the 86% decline from the peak in 1924. Even at the darkest periods, the statistics reveal that it's actually pretty normal to have robust short-term recoveries among the longer-term downward trend. Again, there are a lot of numbers to process, but that's what he's getting at here. On this slope, 12 of the top 20 NASDAQ bounces took place. Along this slope, 9 of the top 20 S&P 500 bounces occurred. He said, after 2000 on May 5th, the NASDAQ had 16 bear market rallies above 10%, averaging 22.7%, before bottoming out at a decline of 78%. The Dow experienced 10 bear market rallies above 10%, averaging 22.8% after 1921, before bottoming out at a decline of 89%. Burry, therefore, exudes confidence despite the fact that it is still in its early phases of a far more serious issue. He also took the opportunity to comment on the relatively modest trading volumes we have observed so far during the 2022 downturn, which he used to support his claim. If you look at the trade volumes, even if the market has slowed down considerably in the year 2002, and everyone appears negative, from what you hear, the market's withdrawals haven't even truly begun yet. The markets are still receiving cash inflows. Therefore, in Burry's opinion, during the next few years, there will probably be a lot more selling volume, which will result in much higher falls in the stock market. And he stated he didn't want to have to deal with that situation. He tweeted on May 24th, as I mentioned earlier, in the year 2008, "I'm not smiling at aches, and it's like seeing a plane fall." The crucial thing to keep in mind about Michael Burry is that he has already witnessed this happening twice, once during the dot-com bubble and once in 2000. He has repeatedly observed these recurring tendencies in human behavior. He has researched the great booms and busts, excess and greed. We can see the S&P 500's run-up over the past 10 years in white. We can see the build-up to the dot-com bubble in yellow, and the build-up to the Great Depression in green. The degree of their similarity is somewhat ominous. Third time a charm? Gotta love human nature, Michael Burry adds in response to this. He tweeted that he had just witnessed the biggest speculative bubble ever, by 2 orders of magnitude, just a year prior. Maybe it's reached its breaking point in his eyes right now. But of course, the stock market is all that matters here. We must keep in mind that Burry's viewpoint is fundamentally driven by the economy. We already know Burry's views on inflation, and it's true that the Fed is raising interest rates to make it more difficult for businesses to borrow money. However, it's important to keep in mind that rising interest rates also have an impact on consumers, who are the basic pillars of the economy. You know, in difficult inflationary conditions, that results in significant increases in interest rates. Unfortunately, consumers have less money to spend because paying off debt consumes a larger portion of their savings and income. This typically triggers a downward spiral, since lower discretionary spending results in lower sales for the businesses in which we have investments. The customer should preferably be breaking it in. Burry has recently, however, made hints that the current state of consumers isn't great. U.S. personal savings, according to the quote, decreased to levels seen in 2013. The savings rate to levels seen in 2000, while revolving credit card debt increased at a record-setting rate, returning to its pre-COVID peak, foreshadowing a consumer recession and additional earnings difficulties. Burry is obviously concerned about the depletion of savings, and not simply because it encourages consumers to use credit cards more frequently in an environment with rising interest rates, but also because decreased spending results from smaller savings, which impacts the bottom line of the companies in which we have investments. You know, Burry recently cited Amazon's Q1 performance as one anecdotal piece of proof. Amazon's revenue climbed 7% in the first quarter compared to a 44% expansion in the same time a year prior. Since the dot-com bust in 2001, it represents the slowest rate for any quarter, Burry said, and the second period in a row of single-digit growth. And so Amazon says to GDP, "Your customer is getting weaker." Following up on that, Burry also tweeted a comparison of U.S. personal savings and GDP. The savings cover a decreasing percentage of the GDP in America, at a time when the U.S. GDP is declining. In general, these factors, inflation, rising interest rates, a decline in consumer savings, and a consequent decline in discretionary spending, lead to poorer business profitability and, as of yet, worse stock ratings for companies. Burry believes that we are still only in the first inning. It's a pretty fascinating subject to investigate. What do you think of Michael Burry's ideas? So, do let us know which topic we should cover next. If you enjoyed the content, give us a like, and please subscribe to know more. See you at the next one.